Welcome to the Monocle Banking Podcast, your weekly foray into the world of banking, finance and insurance, as always curated by Monocle Solutions. Today we're taking a scalpel to South Africa's banking sector. It's a sector that's delivered really solid post-COVID returns, but is now negotiating what I can only describe as a treacherous confluence of headwinds. We've got stagnant economic growth, we do have falling interest rates as well as rising competition, and globally, the uncertainty created by Trump's tariff threats and a customer base that is as digitally savvy as it is cash dependent. And there was a time when investing in South African banks was as simple as picking the big four and letting the dividends roll in. I think those days are firmly over. The traditional banking model with its fat transactional fees and reliable lending margins is being chipped away by a wave of digital disruption and neobanks. PayShap, the Reserve Bank's instant payment platform, threatens to cannibalize legacy fee income. And we've got Capitec with its cut-price SME payment terminal showing the incumbents how to do more with less, especially when it comes into lending to the SME segment. And at the same time, there's a quiet revolution happening inside the banks. Leadership reshuffles from Jason Quinn's jump to Nedbank to Kenny Fiela's move to ABSA does suggest a sector trying to rewire itself for a new era. Well, we're joined now by Byron Jackson-Miller of Foord Asset Management, who believes that selective exposure to the sector is now the intelligent play, and he's backing Standard Bank, Capitec and FirstRand, three banks that, in his words, are price setters rather than price takers, with the kind of tech muscle and cultural agility to not just survive, but to thrive given this confluence of factors. So Byron, great to have you on the show. Let's just start with the big picture. The post-COVID boom for bank stocks is starting to fade into, I would probably say, a murkier macro outlook. Why do you believe selective investment is now the smart move?
Hi, Michael. Thanks for having me on. It's really great to chat to you in what I would agree is a really murkier environment. I think the selective positioning is an interesting one. In a competitive environment, the fight becomes even tougher amongst the banks, and the strongest that we believe are more likely to win. And maybe more importantly, there are less pockets of excess opportunities for the weaker competitors to survive off. So if you look globally at the most successful banks, they actually lent into these tougher periods and used them as opportunities to make themselves better. So maybe more simplistically, if you were to think about food or clothing retailers, as an example, the businesses with wider margins, better brands, and who are nimble have more space to absorb the tough environment and still do well, while the weaker ones are squeezed out. You'd say that the wider margins mean you have more space to invest in price to support your struggling customer and to find ways to incentivize that customer to do more with you. Better relationships and better products tend to mean that you should be keeping the customer happier than they would be elsewhere, which I think is important. And at the same time, it's important to ask yourself, what about if things play out differently? What if the momentum swings and we start to see some of the optimism play out? We still continue to think that the banks that have the best relationships and best products are likely to be best positioned to really take advantage of that. Maybe to come back to some of the specifics of the banks, we think that the banks that offer something unique and mean that you aren't just reliant on the macro environment becoming more attractive are the interesting ones. So as you mentioned, Standard Bank, we see it as it owns a Pan-African franchise that is really difficult to replicate, which drives earnings diversity, and its corporate and investment banking division also position it well for any infrastructure-led upswing that we might see in South Africa. And then Capitec, people often think about Capitec but how does this bank grow? But it has a lot of opportunity to grow amongst the 24 million clients it has, of which currently only 8 million actually do a lot with Capitec. So it can grow 3 times just in its existing client base. And we see opportunities in embedded services and a disruption amongst SME banking, following a proven model that they've done elsewhere. On the other hand, you have FirstRand. We see it remains best of breed and is well positioned to continue to win business from weaker competitors in a tougher environment.
And it was quite interesting. Of all those three banks, I've had all of them on the show recently talking to some of those key areas where they're leaning into. And just most recently, we had Dr. Christoph Nivoet of FNB talking about how they're leaning into their culture of innovation around AI. There's already 100 agentic AI models that they're trying to implement throughout the bank, while Yeah, I chat to some other banks like ABSA, and they still seem to be very uncertain as to how they're going to embrace the digital transformation. I want to come back to the macros for a little while longer. Interest rates hopefully will be drifting lower, probably a little bit slower than one would hope for such a low growth and sluggish economy. But we know the Reserve Bank is having this debate around 3% and anchoring the inflation target at that level. So I tend to think that the hawks are going to hold sway, even though CPI is at 3% at the moment. How much of a threat does margin compression pose to the sector, and which banks are better equipped to defend profitability?
It's an important question and one we think a lot about. So the different banks hedge their loan books to different degrees. So some might feel that pressure faster than others. And so traditionally Nedbank have not hedged much, whereas ABSA would run a very hedged book, so it has less of an impact. But maybe away from the technicalities of that, I think an important thing to remember is that as interest rates come down, hopefully the bad debts that the banks experience also reduce. So although you have top line pressure for the banks, they're seeing less credit problems. And as interest rates come down, you and I are more likely to be able to continue to pay our mortgage. So there should be an offsetting to that. However, what becomes important is the banks that have a franchise that can continue to do things in good and or bad times tend to win out through the cycle. So the ones that are more at risk from the volatility, so the ones that have had tougher times recently, feel that worse. And maybe that means in the short term, when interest rates come down and lending picks up again, they can get a short-term bounce from that. I think really the ones that have good relationships with their clients, that have good products over a long period of time, are more likely to benefit, 6, 12, 18 months out. Mm-hmm. So rather than tracking the short term of what do we think happens with rates in the next little bit, I think it's important to look at that a little bit more holistically.
And through the cycle. Let's talk about PayShap for a while. It obviously has this promise of reducing our reliance on cash. The Reserve Bank has been spearheading this, and through BankServe, we've gone through a process of rapid payments modernization over the last few years. It also chips away at transactional fee income for the banks. So one wonders what the net effect of this might be on the banks, and which banks would be best placed to defend against that or maybe even monetize that shift.
I completely agree. And an important starting point here is to understand why this is even happening. I think South Africa is in a very unique place. So 80% of people have a bank account in South Africa. But in half of these, there's actually one transaction that happens a month. Cash goes in and is withdrawn as soon as it's deposited. And then the person goes on and does the cash through the month, does the transactions through the month in cash. And I think for people, this feels like this cash doesn't cost anything. But actually recently, the SARB thinks that it costs the economy up to 30 billion rand a year. So this is an important project, it's an important thing. And again, to frame why this matters, banks make a lot of money from charging us fees, given that we EFT each other, or even if we want to make an instant payment to each other, and they earn fairly good fee income from that. So you've seen a range of different responses to PayShap. You've seen some banks deliberately go out and say to their clients, you should use PayShap, it is better for you. Here's a number to make you use it better. Others have gone and dropped their fees down really low to incentivize people to use it to drive adoption and increase usage. And other banks have probably been a bit slow to move, and maybe you could even argue have been deliberately cumbersome in allowing their clients to use it. And again, we've seen long through time in banks and in other industries where you try and protect the current status quo, you tend to lose out longer term. Whereas when you move with the innovation and you move with the change, it means that you're able to build the next generation of products that are better for your clients and keep them along for the ride.
And that comes back to your thesis around those banks that are really mindful of the client relationship and how are we continuing to add value. Because when I look at this, I see a real risk that the banks that don't do that risk becoming the utilities in the payment space, while you've got the fintechs and you've got the telcos capturing all of the high margin value added stuff.
I completely agree. And I think increasingly we see the banks move away from just the basic thing of payments and putting money into bank accounts. And they want to do more with their clients. I mean, we could get into the detail at some point on why it's so attractive for the banks. But as the banks do more and more that is not just straightforward payments, that payment information allows them to do those things in a much better way. And they can offer that service to their customers in a way that I think is much better than what customers get elsewhere as well. That innovation is not something that happens in a once-off thing. We're not waiting for a bank to launch a product that just revolutionizes things, but it's culturally inherent within a bank to do small little things that make it better and allow it to continue to compete in that way.
In your report, you've highlighted the importance of non-lending ecosystems, as you've called them. So maybe you can just unpack how platforms like FirstRand's and Capitec's apps are really transforming that customer relationship and then growing additional revenue streams at the same time.
I think it's incredible. If you were to look at someone's bank statement, you would know pretty much everything about that person. You know where they shop, whether they like eating out, if they have a Netflix subscription. And the same token, I don't think much has more attention of their customer than a banking app. I think for most people, it's probably the top 3 or 5 apps that they use every day. So if you combine these two things, you have something you use a lot and you know a lot about this person, you actually get to put things in front of them that greatly improve their experience. So an example would have historically been FirstRand and Capitec were both particularly good at this. And they could look at your bank statement and say you pay 100 Rand a month for funeral cover. Let's rather offer this to this person for 80 Rand a month. This would allow the customer to receive it for cheaper. They could offer the service better through a slick app, and it would work really well. And we've incrementally seen this grow and this move. They saw that people were using their bank accounts to buy airtime, so they started selling them airtime. They use their bank accounts to pay for bills, to renew their car licenses, and this is all kept snowballing. And this moved into betting vouchers, entertainment pieces like DSTV, and now Capitec have seen it as an example to launch Capitec Connect. So now you can use them as your mobile network directly. And then the next step was, okay, they saw how much leaves the account to go into a very expensive way of transferring money overseas. So they're building their own service to do this directly themselves. And so all of this is a long way of saying you used to just use your Capitec bank account to pay someone else. That has become just the reason you get a Capitec account, for example. And now you do a lot around that. So really, if you have so many people using your app, they're already using it. The marginal cost of adding something extra to that app is very low. So it's very high return for a bank. And then it's also because you're using that app so often as the customer, it's a great experience to be able to do something better through the app like that.
I've always thought that's where the banks are uniquely positioned amongst other financial services players, like insurers, for example, in that there is already a naturally high engagement. You as a user of your banking app are on it almost daily. And as you say, it's among the top 5 apps that we interact with. So there is a huge opportunity to then use that data. And as we know, the banks have been investing heavily in IT and sorting their data out, sort of moving into the cloud, and now utilizing that data to cross-sell. How sustainable is that strategy, though, of cross-selling things like insurance and airtime or even remittances? Could regulatory scrutiny become a limiting factor here? Do you think there's a point here at which the regulators start saying, wait a minute, we feel you're stepping over the line?
It's important to take a step back first and say, we spoke about bank assurance 20 years ago for the first time. The banks were always meant to come take away from the insurers because of this inherent advantage. And actually, it's not as easy as just doing it. There's a lot of small little behavioral pieces that have to add up to eventually making it happen. Capitec had to get very good at running very good branches that appeal to customers, that interact very well, and a whole lot of things that move in between that. So it's this long process that doesn't just happen because you flip a switch. It's a whole set of behaviors that have led us here, which I think is quite an important and interesting thing to remember. And then what the regulator decides to do will always be interesting to watch. I think currently we're in a situation where it's net beneficial for all parties here. So the customer tends to get things better, cheaper, more efficiently, with more oversight than they would have elsewhere. The banks run these systems outside of their core banking businesses, so it's not a drain on the banking capital that they have to keep aside in order to make sure that they're strong businesses. And then on top of that, it's not like it's resulting in lower fees to customers. If anything, it's allowed the banks to bring bank account fees down quite significantly. So for now, it feels like a win-win. We have a SARB that is very good at having good oversight and making sure they understand what the impact of these various things are. But as long as it continues to be good for the customer, I think it continues to be strong.
When we talk about this kind of innovation, especially in the SME space, I think Capitec stands out at the moment. Its payment terminals are priced at half the rate of its peers out there. Clearly not just simply a pricing play. How do you see Capitec reshaping the economics of payments for small businesses, and what's its end goal here?
It's a fascinating question because at first it is just they've come in, they've said, our fees are half the price of everyone else. We're going to put a payment system in front of you and we're going to do that. But that really is just the start of the relationship. So for banks, when they bank a small business, being able to put the point of sale device in the store and process those transactions, that means the money often gets deposited into that bank account. So let's call it a Capitec bank account. And then now, because they have that relationship and because they have that data, they can do so much more with it. So, for example, the next obvious step for Capitec is they're able to then lend to that merchant working capital funding. So they'll get to a stage where currently you can, on their website, once there's enough data through your point of sale device, you can get access to R1 million working capital facility within 5 minutes. By the end of this year, they would like that to be R7.5 million that you could get access to within 5 minutes. So that data gives them the space to be able to lend like that. And so an interesting piece of that is they believe giving a business 1 month's worth of working capital should double that business within a year. So that's a very powerful thing. That's good for the business. Again, that's good for Capitec because you're doing twice as much volumes. So that's a win-win all around. And then you can start to do other things on top of this. So for Capitec, again, an obvious example would be Capitec have 24 million clients. They know what these clients are spending money on, and they know who is spending what through what point of sale device and how each merchant responds to different type of clients. So they can build a proposition that says to their business banking clients, we can give you access to these 24 million clients in a very clean and methodical and good way. And you've seen that come across to all the banks. So you've seen them all start to, the stronger ones, be able to build out a proposition that is not just about the central payment system, but really it's about making sure the customer experience of paying is much better as you give them many different options. And then around that, you can do more for the business.
It also comes back to the comments made by the outgoing CEO, Harry Fourie, who retired recently, one of the last founders at the bank as well, around the makeup of the South African economy, when he said he reckons our unemployment figure is probably lower than what the official statistics say it is, given what they see and the access to the data that they've got inside the bank. I mean, would you say he's probably closer to the mark than where our official number puts unemployment? And given South Africa's informal economy might be bigger than many have assumed, that this could become the next major growth frontier, and especially to bank these very small and micro enterprises in the informal economy.
Look, there are much smarter people than I trying to calculate that number. So I wouldn't like to hazard a guess at what the right unemployment number is. But I think he's very much on the mark on the fact that we have a thriving informal economy within South Africa. And it skews very significantly towards cash. And as a result, as you slowly formalize that economy and as you bring digital payments into it, we can have a whole separate discussion about what it means to bring it into a formal market. That's a separate thing. But as you start to bring digital payments to that economy, as it starts to unlock lending, rewards programs, more efficient operations, it's very positive. You can see across the economy through many different levers, whether it be bread sales, informal markets, all those kind of things, just how thriving that part of the economy is. And I think Capitec has been very astute to decipher the fact that this most significant growth is coming there, and they can go in there and create a market by themselves. So they don't necessarily have to come in and disrupt what is an existing legacy industry. They can really come in there and build from a formalized bottom end of the market.
A lot of this does come down to the right culture inside an organization. And, the well-worn saying is, if culture eats strategy for breakfast, then I want to ask you, which South African bank has the hungriest culture for innovation right now?
We've spoken about FirstRand, we've spoken about Standard Bank, we've spoken about Capitec. We hope that they're all feeling hungry and culturally being strong. I think the important thing to say, though, is that culture exists throughout the organization. And it's difficult to find one thing. And it's all these little iterative things that they do. And you continue to see Capitec be the first on solving a lot of these problems, on arriving at new solutions, and are delivering value to their clients across the spectrum. So I think that building in Stellenbosch is delivering a lot of cultural strength right now.
Yeah. Hard to argue against that. I mean, one doesn't want to say that there isn't innovation inside all the banks. There certainly is. But Capitec is certainly setting the benchmark at the moment. Others, obviously are going through their own internal leadership changes. Jason Quinn at Nedbank, Kenny Fila at ABSA. That often signals cultural change as well. How much does that kind of leadership DNA matter when it comes to adapting to tech disruption and taking a big legacy traditional system and moving it into this new world with the requisite speed to compete with the likes of Capitec?
Culture is incredibly important in this regard. I think mostly so because these are not things that you can solve by sitting around a big boardroom table and making a once-off decision. These are things that have to happen on a day-to-day ongoing basis. Everyone operates. It needs to be the right culture that pervades in order to get to the right outcomes here. I think given the changes in the industry, it's very difficult for a single person to create a culture and very difficult for them to change it quickly as well. So as you referenced, Kenny Fila, he's had an incredibly successful career at Standard Bank, but he alone can't change the fortunes of ABSA. We already know that he has to appoint someone to run the new combined retail business and someone to run the CIB business. And even more broadly across the business, we know that there are a number of areas that he's identified that would benefit from adding some skills. So culture is not just a top-down thing, it's a DNA thing throughout. And if you look at the transition at Capitec, you can see how this culture pervades throughout the organization and it pops up in all the different ways. You can tell it from when you go speak to a bank teller across the different banks, or you speak to someone, a business analyst that has just joined, and it tends to pervade. And it's an important navigation tool for any of the banks and how to get through this big transitional period.
We touched on Standard Bank's Pan-African franchise, and that's often seen as a moat. Interesting that I had it put to me recently that in East Africa, the increased capital requirements might lead to some interesting M&A activity there, as East African banks don't have the immediate capital on hand, and potentially some South African banks might go sniffing around again. But when it comes to the Pan-African advantage that Standard Bank enjoys, I think few really come close. Do you think we could see other South African banks replicate that kind of Pan-African approach? ABSA tried to do it with Barclays and then unbundled, or is Standard Bank's advantage now unassailable?
So we unequivocally know that all of the banks are trying to replicate that. I think you referenced East Africa, and don't hold me to it, but within the next year, I'm quite sure that one of our banks will announce an acquisition out there. As you say, it's a fertile ground for something like this. I think it's important to remember with Standard Bank that this is not something that they woke up and chose to do a few years ago. This is something they started doing 20 years ago. You build these relationships and these processes, and each country has its own unique regulatory environment, market dynamic, set of relationships that you need to have. And these things grow very incrementally and very slowly over time. And I think Standard Bank also, to a degree, were lucky with the sets of how things played out for them. So their Pan-African business was really starting to get to some scale as a lot of the other global banks started to leave Africa. So for varying different reasons, largely post the GFC, they started to pull out of the operations of banking multinationals across Africa. And this really gave Standard Bank the opportunity to step in and say, we do a great job across Africa and we can help you across the different regions. And so there are a lot of competitors in a Kenya or in a Nigeria, for example, but you had Standard Bank was able to say, we can help bank this multinational business, help them move currency across an entire continent. And that's very difficult to replicate. So it was something that took time. It was something that's a roll up of a whole lot of small things that they've done. And you can't just replicate that all of a sudden.
Yeah, and that strategic moat is in the time that's been invested in that strategy that they're benefiting from now, and through the broader group with, and you mentioned bank assurance with Liberty and being able to now roll that up. As we get to the end of our time, Byron, if you're an investor analyzing banking in this kind of environment, what metrics matter most to you when analyzing banks in a low growth, high disruption environment? Is it return on equity? I know South African banks have a very structurally sound ROE? And one can argue about exchange controls. Do you look at the cost to income ratio? Do you look at their rate of digital adoption? What do you tend to use as your key metrics when you analyze who the winners might be?
It's fascinating how all those different metrics fit together. I think a lot about return of equity. I think it's incredibly important. Banks at its core are how efficiently can they use the capital that they have, and how efficiently can they take the profit that they make and reinvest it into the business and earn a higher return on that. And that filters all the way down. So we started this conversation with the ones that have better margins, have better returns. They have the space to be able to absorb short-term volatility and become out a much better business. And if you look at return on equity, it's a reflection often of a stronger cost to income. It's a reflection of a better lending franchise, of better bad debt management through a cycle. So really an efficient bank that has a high ROE is a strong one. At the same time, if you look at South Africa, the highest rated bank tech on the highest multiple has by far the highest ROE, and it justifies it to a large extent. So another part of looking at that is you really have to step back and say, even in a bank, you're just trying to buy a collection of cash flows at the best possible price. And when it's a good, well-run business, generally, you're able to better estimate that cash flow. So you do have to step back and say, what do I think these cash flows are going to be over time? And often the ROE informs the ability of the bank to grow those cash flows over time.
And then finally, I've got to ask you, if we were to gaze into our crystal ball 5 to 10 years ahead, I know very difficult to do, but we're seeing the rise of this kind of banking as a service, open banking. There still seems to be a lot of friction between our fintechs and our banks. I think it was best evidenced recently by the Department of Home Affairs upping its lookup fee, and how quickly we saw Time Bank come out and say, no, that's part of our model. It's our cost to onboard new customers, and the incumbents were quite happy to have that price increase because gives them a bit more time. There's a healthy competition. But how do you see this all playing out in terms of what South Africa's banking environment might look like in the next 5 to 10 years? Is there a chance that we effectively see the big banks becoming back-end infrastructure for fintech ecosystems? Or will it be a handful of big players who embrace this that can capture that entire value chain?
We spoke a lot about culture today, and I think that becomes an incredibly important part of this. So the banks that are strong culturally, are culture forward, are innovation forward, I think they have the best starting position here. They have great relationship with their clients, and they should be able to continue to innovate and drive those forward, and should be able to take more share of the market and should be able to be a better business as a result. I think we shouldn't forget that we have an incredibly strong banking sector that is quite different to anywhere else in the world, that has had a traditionally very strong, let's say, top 6 banks, and the ones that are culturally adept should continue to drive home that advantage. I think it's very difficult for fintechs to make a massive impact on that. Having said that, I think that you put it very correctly that 3 to 5 years, the pace of change, the rate of change is going to be significant. And where you aren't on top of that, you probably are to be left behind by your customers. And once you're left behind by your customers, you probably are just the back end for someone else.
And that's where we'll leave it for today. I think what's clear from this conversation with Byron Jackson-Miller, investment analyst at Foord Asset Management, is that South Africa's banking sector is no longer the lazy investor's playground it once was. The days of buying the whole basket and just sitting back are absolutely gone. Today, it's about selectivity. It's about understanding which banks have the pricing power, have the tech, and importantly, the culture and leadership to stay ahead of the curve. If you've enjoyed this episode of the Monocle Banking Podcast, don't forget to subscribe, share, and leave us a review. It helps us keep bringing you conversations that go beyond the headlines and into the real dynamics shaping financial markets. I'm Michael Avery. Take care.